and welcome back to accounting. We are continuing our experiment of learning from pre-recorded lectures, which I'm currently recording on Thursday at the end of A Day. So the first thing you need to do is complete your warm-up. So there are 4 questions here. You should label them 1 through 4, even though I have bullets of pictures of my daughter. So press pause and complete your warm-up. Make sure you turn it into the bin when you're done. So you're back. That tells me you turned in your warm-up, you did it correctly, and you even put your name on it so you get full credit. Good job. This section we're going to talk about chapter 11-2. It's journalizing cash receipts using a cash receipts journal. So we have a couple of objectives. Our main one is going to be journalize cash receipts using a cash receipts journal. And here are the TEKs that were covered. So if you're interested, you can go look these up on the internet and see that we are actually covering the required TEKs. This is a cash receipts journal. We use it when we receive cash, but not only when we receive cash, but also when we receive a cash equivalent. And cash equivalents would be a check, a debit card, or a credit card. Our book, because it's almost as old as I am, says that most sales transactions occur using cash, but of course that's not true anymore because almost everybody carries around plastic, and so most sales transactions these days are made using debit cards or credit cards. But those are a cash equivalent. They are treated exactly the same as cash. When the business takes their receipts to the bank at the end of the night, the bank takes cash and they put it in the bank account in place of the credit card and the debit card slips. So it is actually just like cash. There is a fee for this. The credit card companies charge it, and it's automatically taken out of the bank accounts. So if you look at this journal, which this is, of course, another special journal that we've been using, we have specific columns for the most frequently used transactions, and those are going to be accounts receivable credit, because accounts receivable is an asset account, which is increased with a debit, but it's decreased with a credit. And so if we're receiving cash for accounts receivable or receiving cash on account, it means that our accounts receivable is being decreased using a credit. We have sales credit because sales are a credit. It's increasing the amount of revenue we're bringing in. We have sales tax payable credit because sales tax payable is a liability, and anytime we have a sale, we also have a sales tax with it. So we have to pay that money to the government. And lastly, we have the cash debit column, which means anytime we're receiving cash, we're debiting cash. Since this is the cash receipts journal, every transaction should have an amount in the cash debit column. So you'll notice that we have, of course, an account title, but now we're only going to use that account title column for the general debit or general credit, or if we have an accounts receivable credit, we're going to put the name of the accounts receivable customer. What would be an example of a general debit or credit transaction where we received cash, but it doesn't fall under accounts receivable, sales, or sales tax payable? I'll give you just a second to think about that. If you said owner investing cash in a business, you would be absolutely correct. So again, cash and credit cards are treated exactly the same. Credit cards are cash equivalent. So we're going to talk about having a cash or credit card sale and how we would account for that. On November 4th, we recorded cash and credit card sales of $5,460. Plus we had sales tax of $327.60 for a total of $5,787.60. And it was on cash register tape number 4. Don't forget that at the end of the day, we go into our cash registers and we print off a sales report that tells us all the sales we have for the day, including the amount of cash we had, the amount of checks, the amount of debit cards, the amount of credit cards. And now that's all done very sophisticated in computers, but we're going to go back about 20 years and pretend that this was before the age of computers. And we're going to pretend we're using one of those old-fashioned cash registers that has the tape that feeds through. So at the end of the day, we went and we printed off this tape, and so we looked at the tape, we wrote T for cash register tape, and we wrote 4 because this was the 4th of November, so it's going to be cash register tape number 4. So if you look, I did the math to show you how we came up with our sales tax rate and how we came up for a total amount received. So the total amount received should be the amount of cash that came into our business. The price of goods, well, that'll be the amount of our sale, and then the amount of sales tax will be our sales tax payable. And don't forget that we calculate the sales tax by multiplying the price of our goods times the sales tax rate, which in the examples we're using, it's 6%. So which accounts are affected? Well, we kind of talked about this already, right? We received cash, so clearly cash is affected. We made a sale, so sales would be affected. And every time we make a sale, we have to pay some money to the government in the form of a sales tax, so sales tax payable is affected. And we're going to draw our T accounts, so I'll give you just a second to set up those 3 T accounts and label them with account titles. So how are each of these accounts classified? Well, what kind of account is cash? Where does it fall in the accounting equation? An asset. And what kind of account is sales? Where in the accounting equation does sales fall? It's a revenue account, right? And revenue accounts fall under owner's equity. And sales tax payable, we owe somebody something, so it's going to be a liability. Normal balance of cash is a debit, normal balance of sales is a credit, and normal balance of sales tax payable is a credit. So what is the change for each of these? Well, we received cash, so we must be increasing our cash. We made a sale, which means we brought in more revenue, so we must be increasing revenue. And now we have more money that we have to pay to the government, so we must be increasing our liability. And if you look on the whiteboard to your left, most likely there's a little chart up there that shows you how to increase and decrease each of these using a debit or credit. So we can click through these quickly, right? We know that we increase cash with a debit, we increase sales with a credit, and we increase sales tax payable with a credit. So we want to see what that actually looks like in our cash receipts journal. So this is the same transaction, and this is what it looks like in our cash receipts journal. So one thing that I noticed you guys are forgetting a lot is you're forgetting to write the page number. So if you look up here in the right-hand corner, this is page number 11 of our cash receipts journal, and it's a new page. We know it's a new page because it's on line 1. So we write our year, we write our month, it's November, and we write the day of our month, which is November 4th. The next thing that we do is we place a check mark in the account title column to show that no account title needs to be written. And that's because it's sales, sales tax payable, and cash. These are our accounts, so we don't need to write anything additional besides put that check mark in there. Some of you guys were trying to figure out how you insert a check mark in Excel. The way to do that is to go up to your ribbon at the top, click on the Insert tab. All the way on the far right, there's a little button that says Symbol. So click where it says Symbol. The pop-up, there is, it says Font, so click that. Scroll all the way down to where it says Wingdings. Now on the right-hand side, after you select Wingdings, scroll to the bottom and you'll see the infamous check mark. So you'll select that and then you can copy and paste it into all the appropriate places. So we write the cash register tape number and doc number, and this is where I keep telling you guys that it's good practice to write the letter that comes in front of the number. So doc number tape 4, right? This is a journal that we could have more than just tapes. We could also have receipts for a source document. So we have to write this letter now, as opposed to something like the cash payments journal where we're writing a check. So make sure you don't forget to write your little T. And my mouse has disappeared. There it is. Okay. Next up, we place a check mark in the post-ref column to show that amounts on this line are not to be posted individually. Again, this is chapter 12, so we're not going to go in depth in this. We'll discuss it probably in the next 2 weeks. We write the sales amount, which it says that our sales amount was $5,460. We write our sales tax, which was $327.60, or $5,460 times 0.06. And then we write the cash amount, and the cash amount is the total amount that we received. It's sales plus sales tax. And it's important to take note that cash is sales plus sales tax. I know some of you guys got that wrong when we were working on chapter 11, but cash is sales plus sales tax. So cash receipts on account is the next thing that we're going to discuss. And if you're wondering where we're at in the book, we're on page 261. So cash receipts on account. This means that we sold somebody some merchandise and they said, I'll pay you at a later date. So we sent them a sales invoice and they sent us back some money. So they owed us some money and they're paying it off. So on November 6th, we received cash on account from Fiesta Costumes for $2,162.40. This covers sales invoice number 69. So they're just paying off sales invoice number 69. And it's receipt number 90 because as you recall from last semester, when we receive cash for anything other than daily sales, we have to write a receipt as our source document. And using a receipt for a source document is an example of objective evidence. So receipts are pre-numbered, so 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and I'm not going to count to 90 for you. But it makes it very easy for us to go back and look and see which receipts we're missing. Are we missing a receipt number 87? Why is that? Did we tear that out, or did a corrupt accountant tear that out and give that to somebody and pocket the cash? What happened to that receipt? So it makes it easy to do an investigation. So here's our cash receipts journal. Again, we write the date. We're going to write the account title. So we're just writing the name of the customer, and the name of the customer is Fiesta Costumes. We write the receipt number, which is R90. It tells us up here at the top in our problem. We write the credit amount. Well, somebody owed us money. They paid us some of that money, so now they owe us less money. So it's going to be a credit to our accounts receivable, because accounts receivable is an asset account, and we decrease an asset with a credit. And when we received cash, so it must be a debit, because anytime you receive cash, it's for a debit, right? Next thing we want to do at the end of the month, at the end of every month, is we want to total and prove our cash receipts journal. So the way we do this is we write the date. Since it's November, we're going to write 30. If you guys want me to teach you the knuckle trick so you can figure out how many days are in each of the months, I'd be glad to. We write totals to show that we are totaling out this journal. So we write totals. Then we add each of the columns. We add our accounts receivable credit column, our sales credit column, our sales tax payable credit column, and our cash debit column. After we add these up, and of course we do our rulings, right? So we added these up and we did our single line ruling to show there was a subtotal. We did our double lines to show that we verified this was correct. But we didn't do those double lines yet. We came down to this page in our journal and we wrote each of these amounts. So general debit, 0. General credit, 0. Accounts receivable credit, $9,540 here. Sales credit, $27,480 right here. Sales tax payable credit, $1,648.80 here. Cash debit, $38,668.60 here. So we totaled them. We said, oh great, they do match. So we just proved our cash receipts journal that it's correct. We've been making our entries correctly. And then we're going to do our double line, our double ruling to show that we verified it and we said, yes, this is correct. Okay, so at the end of the month, we have to prove cash. Why are we proving cash? Because we want to prove that the amount of cash that we say we have is the same amount of cash that is in the checkbook. And if you remember, we also use those checkbook stubs when we reconcile a bank statement. So we want to make sure that everything matches and we have as much cash as we say we have. So the first thing that we do is we go look at our general ledger and we look at the beginning of the month, which is November, and we write down the amount from our general ledger. So I already looked in the ledger. We had $17,647.44. So then we added the amount of cash that we received during the month. Well, we got that from the cash debit column in the cash receipts journal. Here's your cash receipts journal. Here's your cash debit column. That's where we got that amount of money from. So we put it right here. We added these two sums together, and we got this amount right here, $56,316.24. So this is the amount of money that we already had. This is the amount of money that we received. Well, now we need to take out the amount of money that left our business. The way we're going to get this is we're going to go to our cash payments journal, and we're going to look in the cash credit column total. If you go back and look in your workbooks, you'll see this line, but I don't have a copy of it in this slide or in this PowerPoint. So we take this amount, we subtract the amount of money that left our business, and this is the amount of money now that we say that we have in our cash account. So this should be our petty cash combined with any cash in our bank account. So then we look at the checkbook balance on the next unused check stub, we write that amount down, and we compare these. Do they equal? They sure do. They're the same amount of money. So this means that we proved cash, and this is done at the end of every single month. So the last thing I have for you is your assignment for the rest of this class period. You're going to check your answers to 11-1 work together and 11-1 on your own. Those should be in a PDF in StuShare. You're going to complete the 11-2 work together and 11-2 on your own tabs in your workbook. And then you're going to complete 11-1 and 11-2 application problems in your workbook. Next class, we'll do the mastery problem, and we will turn this all in together at the end of the next class, and then we'll be ready for yet another test. All right, get to your work now.